which has happened mainly coming from.
Good. Megan, thank you very much for being here today. We are in Switzerland, in St. Moritz, the Chairmen's Retreat. You were the opening keynote today. How did you feel? Did you meet the right people? How was the experience for you so far?
Well, thank you for having me here today. I have really enjoyed my first GRI Chairman's Retreat in St. Moritz. There was a great sense of optimism in the room, a large crowd, larger than I was expecting, of very senior professionals, very friendly. And yeah, I think the sense of optimism around the future for commercial real estate, particularly here in Europe, it was very positive.
It was very impressive when we saw the results. We asked the audience if they're optimistic, neutral, and most of them said that they were optimistic, which was different from last year, as we could see in the graph. And why do you think that is the feeling at the moment? Do you sense that we're going to have a positive year as well?
Well, I think there's two reasons for the optimism. One is undoubtedly we're through the worst of the capital value falls that we've seen in commercial real estate, and that's been globally from the rise in interest rates. So that capital value loss that we've seen, you can start to see reflected in the data, has now finished. I think the other reason for a sense of optimism is, actually I'm going to talk a little bit about the IMF Global Financial Stability Review. They did a very large survey of 398 banks to look to see if commercial real estate lending posed a systemic threat to global financial stability. And the results of that have been that real estate has actually been given a sort of relatively clean bill of health by the IMF in its report. You can find it online, Global Financial Stability Review, October 2024. And so there's a sense that bank lending back to commercial real estate will start to come forward again. Obviously, we still have the cost of debt to think about. It's right in line with cap rates at the moment, but it doesn't take a lot for banks to feel a bit more relaxed and margins to come in a little bit, and for buyers and sellers to adjust their pricing a little bit to start to see deal activity come back to the market.
Very interesting. One of the things that we discuss here today is that the GI announced that we're going to open an office in Dubai to cover the GCC region. Can you elaborate a little bit for us why the GCC region is relevant at the moment for different markets, not just for Europe, but the US and other markets as well?
Yeah, that's a great question. Look, we've seen this is actually my fifth real estate downturn. I've been in the industry for some time. In any real estate downturn, transaction volumes tend to fall away, and they've certainly fallen in this one. So we're running at about half speed transaction volumes. But even in a real estate downturn, you will always have what I would call core buyers, all equity buyers with long time horizons. And so in any real estate downturn, they tend to be high net worth family offices will always buy all equity because they have a long timeline, quite often buying in their home cities. Sovereign wealth funds often buy because they will buy all equity and again have a very long time horizon, and what we might describe as oil money. And so, you know, they have long time horizons. They want to deploy capital really for future generations. This isn't a short term 3 to 5 year. This is more maybe a 15 to 20 year deployment for their capital horizon. And so in this market, there have been active buyers out of the GCC. So I can understand why GRI wants to open an office in that location.
You mentioned something very interesting, and I wish I could just know everything you know. For passing through 5 different cycles, you saw different kind of challenges in the real estate industry. If you had to choose one key lesson learned from all the cycles, what would that be?
So I think the one key lesson to surviving a real estate downturn is to minimize the amount of leverage or the amount of debt that you have, whether that's on your specific construction project or in the deal that you're participating in or in the assets that you hold. Lower levels of leverage allow you to hold through the cycle. I mean, it's no surprise that core real estate usually has relatively low levels of debt in it, and it allows you to hold right through the cycle. So I think, yeah, the one key lesson to take away is to minimize your levels of debt and ensure you have sufficient slack, whether that's in your personal bank account or in your project, to make sure that you're not over leveraged.
Megan, thank you very much.
Thank you.
Which has happened